Are you tired of watching a significant portion of your hard-earned money disappear into taxes each year? You're not alone. We're going to talk about minimizing your tax liability legally and ethically. We're not looking to evade taxes. That's like trying to outrun a hound dog in the bayou. Ain't gonna happen. We're going to talk about intelligently minimizing your tax liability through proven strategies used by financial experts. Think of it like this. You worked hard for your money. You deserve to keep as much of it as possible. We're going to explore some powerful strategies that can help you do just that. So sit back, grab yourself a glass of sweet tea, and let's dive right in. Now, when it comes to taxes, your business structure is like the foundation of your house. It's the base upon which everything else is built. You want it strong and sturdy, capable of supporting your business as it grows. Choosing the right structure can make a world of difference in how much you pay in taxes and how you manage your finances. First off, we got the sole proprietorship. It's simple, straightforward, like a good pair of overalls. Easy to manage, but it comes with its own set of challenges. You and your business are considered one and the same for tax purposes, meaning all profits and losses are directly yours. Now, this might be a good option if you're just starting out, but it might not be the most tax efficient in the long run as your business grows. Next up, we have partnerships. This is where two or more folks team up, kinda like a good old barn raising. It's all about collaboration and shared effort. They share the profits, losses, and you guessed it, the tax liability. It's a joint venture in every sense. Now, if you're looking for a bit more separation between your personal and business liabilities, you might consider an LLC or limited liability company. It's like putting a fence around your property. It provides some personal protection and peace of mind. It's best to consult with a tax professional to figure out which one's right for you. They can provide tailored advice based on your specific situation. Now, when it comes to picking the best business structure, the amount of money you're bringing in plays a big role. If you're just starting out and your revenue is flowing like a gentle stream, a sole proprietorship or partnership might be a good fit. But if you're bringing in a heap of cash like a river running wild after a storm, well, you might want to consider an S-Corp. See, an S-Corp lets you take some of your income as salary and some as dividends. And guess what? Dividends ain't subject to self-employment tax. That's right, you heard me correctly. Now, if you're making over $75,000 a year, an S-Corp could potentially save you a pretty penny in taxes. It's always best to talk to a tax professional to see if an S-Corp is the right fit for your situation. They can help you weigh the pros and cons and make the best decision for your bottom. Deduction if you qualify. If you're working from home, you might be able to deduct a portion of your so stay organized and keep those receipts handy. Chapter 4. Now let's talk about the home office deduction. This is one of the most overlooked tax benefits out there. If you're running your business from your kitchen table, listen up. You could be missing out on some serious savings. You might be missing out on some serious savings. The home office deduction can significantly reduce your taxable income. To qualify for the home office deduction, you need a dedicated space in your home that's used exclusively for business. This means no personal activities in that area. Now, I ain't talking about your living room where you watch TV and answer emails. That won't cut it. I'm talking about a separate room, like a spare bedroom or a converted attic, that's used solely for work. This space should be clearly defined and used regularly. Now here's the catch. That space has to be your primary place of business. It should be the main area where you conduct your work activities. If you're renting an office outside of your home, you can't claim the deduction. The IRS is pretty strict about this rule. But if you're working from home full-time or even just a few days a week, and you got that dedicated space, you could be eligible for some sweet tax breaks. This can make a big difference in your annual tax bill. You can deduct a portion of your rent or mortgage, utilities, and even your property taxes. These deductions can add up quickly. The simplified method is, well, simpler. It's a flat rate per square foot of your home office. The regular method, on the other hand, requires a bit more paperwork. You'll need to calculate the actual expenses related to your home office. Chapter 5. Now let's talk about vehicle and travel expenses. If you're using your personal vehicle for business purposes, you need to be keeping meticulous records. It's like tracking the stars in the night sky. Gotta know where you've been and where you're going. When it comes to deducting vehicle expenses, you got two options, the standard mileage rate or the actual expenses method. The standard mileage rate is like taking the scenic route. It's simple and straightforward. You just multiply your business miles by the standard mileage rate for the year. The actual expenses method, on the other hand, is like taking the back roads. It's more complicated, but could potentially lead to a bigger deduction. With this method, you track all your actual vehicle expenses, including gas, repairs, and even depreciation. Now, if you're traveling for business, you can deduct those expenses too. Keeping detailed records is crucial for deducting vehicle and travel expenses. Chapter 6. Now let's talk about investment strategies that can help you reduce your tax burden. It's like planting seeds that grow into money trees. Gotta invest wisely to reap the rewards. One of the smartest things you can do is maximize your contributions to tax-advantaged retirement accounts like 401ks and IRAs. These accounts allow your money to grow tax-deferred, meaning you don't pay taxes on your earnings until you withdraw the money in retirement. Another great option is a health savings account, or HSA. This is like having a secret stash of cash specifically for medical expenses. You contribute pre-tax dollars, your money grows tax-free, and you can withdraw it tax-free for qualified medical expenses. Now, if you're looking for more immediate tax savings, consider investing in municipal bonds. These bonds are issued by state and local governments, and the interest income is often tax-free at the federal level and sometimes even at the state and local levels. Remember, tax planning isn't a once-a-year activity. It requires regular attention and adjustments throughout the year. The strategies we've covered today could potentially save you significant money, but they need to be implemented correctly. Here's what you should do next. Create a tax planning calendar for the year. Schedule quarterly reviews of your tax strategies, and consider consulting with tax professionals for personalized advice. Think of it like tending to your garden. Gotta stay on top of it to see those beautiful blooms. Don't leave money on the table. Start implementing these strategies today. And remember to subscribe to our channel for more financial optimization tips.